Welcome to the third episode of my 5-week trading bootcamp, a free crash course for those dedicated to mastering trading in the best and simplest way possible. My name is Sam, but you can call me ATP, and I have enhanced my skills through extensive study and certifications at Oxford and other respectable institutions. Now I'm here to simplify complex trading concepts and empower new traders to succeed. In the first episode, we covered the trading basics, defined key concepts, and started building an indicator-based strategy from scratch. Then, in the second episode, we explored a powerful risk management system to maximize profits and selected a reliable exit indicator that significantly improved our strategy's consistency. Today, we'll focus on boosting our system's efficiency using a volume indicator. A straightforward yet effective approach. If you are new here, subscribe now and get ready to elevate your trading journey. Let's dive in. Similar to our previous episodes, let's begin by addressing another common trading myth. More trading equals more profit. This misconception suggests that the more trades you execute, the greater your potential for profit. However, this notion overlooks the fundamental risks and costs associated with frequent trading. In reality, excessive trading can lead to increased transaction costs, such as spreads and commissions, which can eat away our profits. Furthermore, trading too frequently can expose traders to emotional and impulsive decision-making, often resulting in losses. Instead of focusing on quantity, successful traders prioritize quality over quantity. And by doing so, today we will explore a method to enhance the quality of our setups by trading only during periods of high market volume. To achieve this, we'll seek an indicator that can identify these high volume periods and add it to our system. By adopting this approach, we can reduce the number of trades per year, saving money in commissions, increase our win rate, and potentially boost profits while minimizing drawdown. So, 4 big advantages by adding just one indicator to our system. And yes, it is completely possible to increase profits while decreasing the number of trades. And I will prove this during today's episode. Before we dive in, let's recap our current strategy for the 1-hour time frame for trading Forex, crypto, and metals. Our setup includes the C1 indicator, Dora Stochastic, with settings 12, 18, and 11, which proved to be the most consistent choice after testing 100 different options. Additionally, our exit indicator is the Arun indicator with a length of 14, selected as the best choice after analyzing 90 different options. For our risk management system, we are using the ATR bands with a multiplier of 2 to set up our stop losses, take profits, and trailing stop losses. I won't delve into this again since it was covered in episode 2. The key takeaway is that our current system takes every trade signaled by the Dora Stochastic, resulting in a higher number of trades. However, some of these trades are losing signals that occur during choppy market conditions, which are periods where prices lack clear direction. So that's why a volume indicator is crucial. In theory, a volume indicator measures the amount of trading activity in a given period, helping us evaluate the intensity and strength of price movements. Common volume indicators include volume bars, the on-balance volume, the money flow index, among others. But to discover which volume indicator is the best for our strategy, we will need to do the same process we used to discover our C1 and exit indicators. Test several different indicators with this function under the same conditions, compare the results, and select the most effective one, using both in-sample and out-of-sample data. If you have any questions about this process, refer back to episode 1, where I explained everything in detail. And so, what you need to do is very simple. After inserting your C1 and exit indicators on your charts, which in my case are the Dora Stochastic and the Arun, we will add one volume indicator at a time on our charts and analyze its performance. For instance, if I want to assess the effectiveness of the choppiness index, I will search for it here, add it to my charts, and then rewind to analyze which signals are filtered out. With the choppiness index, I will only consider trades that appear when the chop value is below the 50 level, indicating non-choppy market conditions. During the backtest, make sure to record each trade, perhaps using a simple Excel sheet like the one I showed you in episode 1, so you can later compare the performance changes in your strategy. Likewise, you should test other volume indicators using this method. If you are looking for ideas or need help with a specific indicator, don't hesitate to reach out in my free Discord community, where we can assist you. So, let's dive straight into the backtesting of several volume indicators. While I could manually conduct this backtesting, as demonstrated in the first episode, I prefer to accelerate the process using my indicators testing bot, the same tool I used in the past episodes. After inserting my conditions, this trading bot performs the backtest for me within seconds, inserting all the trades on my chart, including their respective stop losses, take profits, and even trailing stop losses. Then it creates this table where I can analyze the monthly results, and in the strategy tester tab it shows me the overall performance of the strategy. If you'd like to use this indicators testing bot as well to accelerate your backtesting, it is available for everyone. In addition to me, dozens of traders also use this exceptional tool, and the feedback has been amazing. Check out the description and this link for more information about it. However, if you prefer a manual approach, you can use it, but be aware that it will be more time consuming. Now I will begin testing indicators with this volume function. After inserting my in-sample data, the risk management criteria, the dollar stochastic as my C1 indicator and the Arun as my exit 1 with their respective settings below, I can scroll down until the volume section. Here I can click on this option to use a volume indicator to filter trades, and here I can select which volume indicator I want to use, also with the respective settings below. At the moment I have 10 options here, but every week new indicators will be added. So for example, if I select the choppiness index here and click on OK, you can see that the bot updates everything, and now it will only enter in positions when the chop value is below the 50 level. The same principle applies to any of these indicators. So I will conduct the in-sample backtest in the same way as in the other episodes, noting the values of net profit loss, number of trades, win rate and max drawdown, provided by the strategy tester tab. I will accelerate the backtesting process and show you some clips of it, but you have the option to adjust the speed in the YouTube settings to see how the bot operates. I will see you again once I have completed all the in-sample backtests. After analyzing 30 possibilities with different indicators and settings, I have compiled them all into this table to have the final results organized. As usual, besides the 4 different statistics I took note from the Strategy Tester tab on TradingView, I also recalculated the return over max drawdown ratio. If you recall, on the last episode, our in-sample win rate was 43.01%. And so you can already see that in almost every volume indicator it has increased, which is a good sign. By ordering the results using again the return over max drawdown ratio, the indicators that performed best in my in-sample data were the ease of movement with the default settings, followed by the check-in money flow with the length of 30, and in third place the volume oscillator with the settings 10 and 20. So now, to confirm the effectiveness of these top 3 volume indicators and to discover which one is more consistent, I will apply them with the same risk management and across the same 5 assets, but this time to my hour of sample data, which in my case is 2023. To do this, I simply need to adjust the data sample in my trading bot here and rerun the backtest for these 3 indicators, which will be very quick with the help of my trading bot. In the meantime, I would like to introduce you to XTB, the broker I use for trading in my personal accounts and investment portfolios. The great advantage of XTB is that it allows you to trade without commissions and with almost zero spreads, making it one of the top brokers nowadays. Additionally, XTB is a properly regulated broker. To create an account, you can use the link in the description to support me. After applying the 3 volume indicators to my hour of sample data, let's take a look at the results. To compare them with the performance in the in-sample data, I created again another Excel sheet with the percentage differences for each statistic using this simple formula. As we can see, the most consistent volume indicator is the ease of movement. It not only shows higher values of return of a max drawdown ratio, indicating greater profitability, but also reveals the smallest differences between the 2 sample sets. Additionally, all the other statistical metrics show slight percentage variations, setting the ease of movement as the most consistent volume indicator for our strategy. Now let's compare the results with our final results from episode 2. Where we only use the dollar stochastic and the Arun indicators, so I can prove to you how important a volume indicator is. As you can see, the improvements are significant. Both win rates across samples have increased, max drawdown has decreased, and the most exciting part, the total net profit has risen while reducing the number of trades. Previously, we achieved the total net profit of 272.09% over approximately 3,351 trades, and now with the addition of the ease of movement, our total net profit has increased to 286% in fewer trades, about 2,287 trades, which is an incredible achievement. So the ease of movement will be my volume indicator moving forward. For those who don't know, the ease of movement is a volume-based oscillator designed to assess the relationship between price movement and volume, and it is very simple to use. When this green line, which is the ease of movement value, is above the 0 level, it means that you will only enter in long positions, and when it is below it, you will only take short signals from the dollar stochastic. And that concludes our 3rd episode of this trading bootcamp, where we analyzed how we can use a volume indicator to enhance our strategy. Not only did I teach you the process of selecting this indicator, but I also demonstrated its effectiveness with real results in our trading system. But prepare yourself for even greater results in the next episodes of this bootcamp, where our system will see further improvements that you won't want to miss. Additionally, I will also teach you how you can create a professional Excel sheet like this one, providing deeper insights into the results of your trading strategy. This detailed analysis will empower you to track performance metrics, evaluate key indicators, and refine your approach for optimal trading outcomes. So subscribe and hit the like button to show me your support. Also, if you enjoyed seeing my working methods and would like to work one-on-one with me to enhance your trading system and become a better trader, you can explore all my available services on my website, algotradepro.org. And that's it. Thank you, and I will see you in the next week. Bye bye.